Are you ready to make the most of your oil and gas mineral rights? Welcome to the Mineral Rights Podcast. Get the knowledge and resources you need to manage your minerals and royalties. Here is your host, Matt Sands.
Hello and welcome to the Mineral Rights Podcast. I'm your host, Matt Sands, and I'm joined by my co-host, Justin Williams, and we're here to help you make the most of your minerals and royalties. And in this episode, we're going to talk about why I think natural gas should really be trading for $12.50 per thousand cubic feet instead of $2.50. So this may come to a surprise to many of you listening to this because natural gas has been so low for the past year or two, but it wasn't too long ago, Justin, that we had natural gas trading around $10 per thousand cubic foot. And, there was a lot that went into it, including supply and demand. And there's, I think, a strong case to be made why natural gas prices should be higher than they are today, whether they hit $12.50. And we'll tell you how I came up with that number. But Justin, we're kind of in a glut right now with natural gas.
Yep, you said it, Matt. And we've been talking about this quite a bit as far as the reason that we have such an oversupply, but it really breaks down to, supply and demand. That's the major thing that impacts the price. And there's three major factors that affect that. It's the amount of natural gas production, the volume of natural gas in storage, and then the volumes of natural gas imports, Matt. And these have been kind of consistently growing as an oversupply situation over the last year or two. And then there's the three major demand side factors, which is variations in the winter and summer weather, economic growth, and then the availability and prices of other fuels, and then volume of natural gas exports, which we've done a lot of talking about how we're hoping that that'll increase. So, Matt, there's a lot of things applying the pressure and pushing the price down, but the density is really the thing that we're going to get into here.
Yeah, the energy density is the key thing. And that's why I say that it should be $12.50. And I'll tell you how I came up with that number. But, like Justin mentioned, ultimately, natural gas is heavily influenced by market supply and demand. And increases in supply generally result in lower natural gas prices, and decreases in supply generally lead to higher prices. So on the flip side, on the demand side, increases in demand lead to higher prices, as you would expect, and then decreases in demand lead to lower prices. So in the way that we see that is through things like the weather. And, it's interesting when you look at supply increasing. So we have the shale boom from the supply side and things like weather that impacts supply, and those can cause spot prices. That means like the daily price of natural gas to fluctuate wildly during those times of big changes. And Justin, do you want to talk about how the U.S. has increased our natural gas production over the past several years?
Yeah, absolutely. So from 1986 through 2016, annual natural gas consumption was higher than dry natural gas production in the United States. However, dry natural gas production began increasing substantially in 2006. That gap closed in 2017 when production exceeded consumption. Annual dry natural gas production remained higher than annual consumption through 2022. The average annual U.S. natural gas spot prices and residential prices decreased in 2009. And in the most recent years through 2018, before increasing in 2019 in each year through 2022. The price increases were partly due to increased demand by most consuming sectors and to increased natural gas exports, especially LNG or liquefied natural gas. And Matt, we've got some information and some charts here that we'll share in the show notes on the consumption, but we've been talking about this story and it just kind of continues here.
Yeah, it really continues, and it's really a testament to ingenuity in the oil and gas industry. We've talked about the shale boom extensively, but basically that increase in dry natural gas production corresponds directly with when we combined horizontal drilling and hydraulic fracturing, and we're able to start producing tremendous amounts of natural gas from these shale formations, particularly in Appalachia, in the Marcellus Shale, and in the South, in the Gulf Coast, in the Texas-Louisiana border, the Haynesville Shale. Those are two of the largest sources and formations that we've been producing natural gas from. And that boom in natural gas, along with the tremendous amount of natural gas that comes as a byproduct of oil production in the Permian Basin, has really caused an oversupply situation. And that's why gas prices have remained largely depressed since that 2008 timeframe, with the exception of the invasion of Ukraine and that disruption in the energy markets, when we saw the actual spot price of Henry Hub natural gas, which is the main trading hub in Louisiana, almost reached $10 per million BTU. And in fact, in the city gate price, which is basically the retail natural gas price, at our homes, what we pay the utilities after we've transported it thousands of miles to our houses, it was actually well above $10 per thousand cubic feet. So those disruptions in supply can cause ripple effects to prices. And, that goes over the long term from the economy, as we have a strong economy and we have growth in the economy, that creates additional demand. If we build new buildings, for example, they need more electricity to power that or more natural gas to heat those buildings. And so that's another source of demand. And industrial plants, that's another huge source. So as, again, the economy is booming, we have demand increasing, and that usually drives prices up. On the other side of that, we have short-term disruptions like we just experienced, Justin. You want to talk a little bit of how severe weather can disrupt supply and how that can affect prices?
Yeah, man, absolutely. And, I think it's something that a lot of people don't consider how large of an impact that can have. But hot weather, winter weather can both impact it. During cold months, natural gas demand for heating by residential and commercial consumers generally increases the overall natural gas demand and can put that upward pressure on prices. And similarly, hot weather can increase the power demand for natural gas as well to create the energy for cooling our homes. And it goes both ways. On the other side, with affecting supply, severe weather, if it takes rigs down like we saw in Texas a couple years ago in the winter where a lot of the rigs froze over, that can really impact supply as well. So we're kind of a victim to Mother Nature when it comes to that. But Matt, it doesn't take much to really disrupt this. And I think a few years ago, or maybe it was a couple years ago now, we were talking a lot in the winter about how there was peak demand and we were expecting a cold winter, which would push those prices higher. So this is a cycle we go through yearly.
Yeah, if you look at an annual price of natural gas, it's very cyclical. In the wintertime, it goes up just because, like what Justin mentioned, you have the increased demand for natural gas in the winter for heating our homes. And then, similarly in really hot periods where we're using a lot more electricity, and natural gas has displaced a lot of coal-fired power plants because it is a lot cleaner burning and we're really looking to reduce emissions. And so a big chunk of our electricity grid is run on natural gas. And so that can also cause prices to go up if it's a really hot period and we need to cool our homes. We have air conditioning running a lot more than normal. So it's interesting that you have both cold weather can influence demand and then also hot weather. So it's sort of like you can't win, in terms of if you're trying to keep prices low. If demand goes up over a short period of time, it can cause prices to spike. And certainly you feel that in Texas where it's a deregulated energy market. And so listeners in Texas, you probably can relate to this in terms of looking at your energy bill, whether it's electricity bill or gas bill, and seeing big spikes during time periods when demand was very high and supply was low. And in fact, like Justin mentioned, that real extreme winter storm a few years ago, we saw extremely high prices for natural gas locally there and extremely high spot prices for electricity just because of that disruption in that balance between supply and demand. So, okay, so we've talked about kind of the fundamentals, Justin, and how supply and demand affect prices. We've seen an oversupply situation, and that's largely the story for why natural gas is so cheap right now. It's been hovering in the recent weeks, $250 to $275, compared to oil, which is trading around $75 a barrel. And so that, in my mind, is a big arbitrage opportunity, right? So energy content you mentioned earlier, do you want to dive into a little bit more how natural gas might be severely undervalued right now and how that just energy content story could play into future price for natural gas?
So, Matt, yeah, let's talk about why natural gas might be severely undervalued and how that this pricing quirk could lead to some exciting new applications. So, in recent years, Matt, we've talked about how the shale boom has impacted this and resulted in the United States producing so much natural gas that the prices have actually gone down. And we've stumbled upon this massive energy buffet, but we're still paying for the kids' meal. So let's throw some numbers. Right now, natural gas is trading at around $2.70 per thousand cubic feet. Meanwhile, crude oil is hanging out at about $75 per barrel. Now, you might be thinking apples and oranges, right? But that's not quite right. Here's where it really gets interesting. In terms of energy content, 6,000 cubic feet of natural gas is roughly equivalent to 1 barrel of oil. So if we do the math, and don't worry, Matt has done this math for us, thank goodness. Based on the current price for a barrel of crude oil, natural gas should be priced at around $12.50 per 1,000 cubic feet based on its energy content alone. And so, Matt, really what we're saying is that you can get more energy created from this natural gas than what it's really priced at right now. And again, as Matt said, it's an arbitrage opportunity. It's like finding a store that's selling $20 bills for $5 each. And just like the scenario, it would lead to people buying up all those cheap $20 bills. The natural gas pricing quirk is leading to some innovative solutions. And Matt, that's really potential for new demand. And diving into that, it's not just some of the industrial applications that we've seen, like paper mills and things like that, but there's a whole world of data centers that is something that we weren't really thinking about 20 years ago. And the energy consumption for those are massive.
Yeah, the energy consumption for AI in particular, and that's really the thing that's been growing exponentially over the past several years. So every time that we do a search, whether you download the ChatGPT app on your phone, and it's, I did recently, and it's pretty interesting. You can talk to it, you can have a conversation with it and learn about new topics and things like that. But each of those prompts that we give and queries that we make with that AI, it uses a tremendous amount of electricity to process and run through the model and trying to find out what the answer is to your question. That doesn't come for free when we're talking about energy. And when we train those models in particular, that uses an extreme amount of energy. So you're feeding it, gigabytes or terabytes of data, and you're asking it to learn through that. It's having to churn through and do a lot of computations. And that computational power demands a tremendous amount of electricity. And so we're talking about energy consumption on an industrial scale, so gigawatts of energy. And according to recent projections, the demand for electricity from data centers, and especially those running AI operations, not just your Amazon cart and running and buying stuff online, but that is set to skyrocket. In fact, S&P Global Commodity Insights had an article recently that suggests that by 2030, the total U.S. lower 48 peak electricity demand could hit 870 gigawatts, up from around 800 in 2023. So that's almost 10% increase, and that is mostly expected to come from data centers. And it's interesting that the oil companies are starting to take notice to this. And so, Justin, do you want to talk a little bit about that and what the industry is saying about this?
Yeah, absolutely, man. So, the CEO for Chevron, Mike Wirth, said at a conference in Houston that natural gas will help power the rapid growth of artificial intelligence with its insatiable demand for reliable electricity. Wirth said during a keynote address opening the annual Gas Tech conference. And he's not wrong. And AI's advance will depend not only on the design labs of Silicon Valley, but also on the gas fields of the Permian Basin. And that was what he was really talking about and kind of opening the presentation with. And Elon Musk is another person that's been in the news with this kind of developments with power. His AI company, XAI, recently made headlines for an unconventional approach to powering their data centers in Memphis, Tennessee. They installed natural gas burning turbines right at the data center site. There's a lot of debate right now. He could be in some hot water for doing that without the proper permits. But it illustrates a crucial point. Tech companies are starting to take their power supply into their own hands, and they're turning to natural gas because it's reliable, it's cheap right now, and it's easy to depend on. It's also a clean alternative to the typical oil. And I think that's something that we've talked a lot about, Matt, but there's still a stigma around natural gas on people not realizing just how clean it is to burn it. And that price disparity we talked about earlier, this is where it starts to play out in the real world. But it's not just Musk making moves in the space. There's a lot of other big players, Oracle, Microsoft. There's a lot of people making changes right now to take advantage of the low price of natural gas.
Yeah, that's exactly right. And interestingly, Oracle is planning to invest over $6.5 billion in Malaysia to build a cloud services center. And it's no coincidence that Malaysia happens to be the world's fifth largest LNG exporter. And so that facility will provide access to NVIDIA's chips for AI development, and it's going to be powered by natural gas. And so that's another company that's been in the news a lot lately is NVIDIA, and why their stock price is just going through the roof. It's because the almost insatiable demand for their processors. In fact, their GPUs, they have a very advanced AI GPU, which is a graphics processor unit, so GPU stands for. And basically, these are not cheap. These are not like the graphics cards that we plug into our computers to play video games. These are like $30,000 advanced. They have an extreme energy demand as well. So it wouldn't be something you could just plug into your computer, but this is like a data center style card that you put in, or these are data center and industrial chips for AI. And, these are things that basically are really driving that demand for energy, and particular natural gas. And it's interesting, that they're looking at nuclear and natural gas. So Microsoft made headlines recently by inking a deal to buy power from the soon to be restarted 3 Mile Island nuclear power plant, which, we aren't know very much about through the partial meltdown that occurred in the 70s. This is from a different reactor than the one that melted down. And so it's a different situation. It was one that was up and running up until a few years ago, but they're going to put it back into commission over a couple of year period. And, Microsoft is willing to pay $100 per megawatt hour. And so it's interesting that they are willing to set sort of a price for what they're willing to pay for the power for those AI data centers. And at this point, natural gas could come in a much quicker time frame, also provide reliable power at a lower cost. And that's, I think, going to be a huge opportunity that these tech companies are going to pursue. Ultimately, they have this demand that they need to be building these data centers to stay at the forefront of this technology. They need to power them with reliable power. So that means wind and solar are out, even though they have all made commitments to reduce emissions. So nuclear is, of course, the cleanest when you compare nuclear versus natural gas because it's got zero carbon emissions. But in the meantime, I would not be surprised to see companies, we saw Oracle, for example, and others like Amazon, who are the data centers in Saudi Arabia, again, inking a multi-billion-dollar deal over the next couple of years to set up shop in an area that is got a lot of natural gas, and there's no coincidence there. I think that's, really a huge source of demand. And we've, of course, talked about LNG as a big source of demand for natural gas, and I think that's going to continue as well. But Justin, do you want to talk a little bit about what some of these big natural gas producers are saying about this, and in particular, Toby Rice, who's the CEO of EQT?
Yeah, man. So Toby Rice, the CEO of Appalachian Power, EQT, like you said, has predicted the AI data center related power demand could outstrip liquid natural gas exports in the coming years. In fact, in a recent Bloomberg article, they mention that Jack Fusco, the CEO of Cheniere Energy, noted that 1 gigawatt of load equates to about 1 million metric tons per year of liquid natural gas fueled power generation. And if we extrapolate from the projected increase of 70 gigawatts by 2030, we're looking at potential incremental natural gas demand of around 9 billion cubic feet per day. That's an equivalent of an entirely new set of liquid natural gas export projects to come online. Matt, and we've talked about how the United States has some of those kind of waiting in the queue, waiting on permitting. The surge of demand could have significant implications for the natural gas market. And the beauty of using natural gas for data centers is its flexibility. Unlike some renewable sources, natural gas can provide that consistent, reliable power regardless of the weather conditions. And that's crucial for AI operations that need to run 24/7. Plus, with advances in efficient natural gas turbines, these data centers could be more environmentally friendly than traditional coal-powered alternatives. Matt, it's also, I think, worth mentioning that with technology and development of technology like this, when it comes out, it's typically not the most energy efficient form of it. And as this continues to evolve, natural gas allows them to scale it up and scale it back. So if this technology becomes more energy efficient, they're not stuck with something like a nuclear power center, and they have the ability to scale that back if needed. But, this trend isn't without controversy. Environmental groups have raised concerns about the emissions from these gas-powered data centers. The challenge for tech companies will be balancing their needs for reliable, cheap power with their often stated commitments to sustainability. And it will be really interesting to see how big tech drives this initiative forward. Like you said, Matt, it's interesting to see that Microsoft is kind of setting the price for what they're willing to pay for energy. It'd be a game changer for both industries. It provides a new growing market for natural gas producers, potentially helping to correct the price imbalance we discussed earlier. And then for tech companies, it offers a solution to their ever-growing energy needs, allowing them to push the boundaries of AI development. And in the situation we're in, natural gas the price is depressed and it's readily available. So it makes sense that they're looking to that for a quick change.
Yeah, and it's also something where they can go to the source. These data centers are sort of location agnostic. They don't have to be located in a major city where you're using, making the queries for the AI or whatever. They can go and build these data centers near the source of power, and that's what they're doing. So that's, I think, why Microsoft is co-locating their data centers near the 3 Mile Island nuclear reactor. You have companies building stuff in Saudi Arabia, Malaysia, and so I wouldn't be surprised to see things pop up in Appalachia or, in the Haynesville or even the Permian. I think the one thing that you have to keep in mind with data centers is those chips create a lot of heat, and so they need to cool them. And it's to a certain extent, if you locate these facilities in a place that's a little bit cooler, it's a little bit easier for them to cool and uses less energy. But ultimately, that it's going to be really dependent on where there's a cheap supply of energy, and that may actually mean building these data centers near these sources of natural gas and these natural gas fields. So that'll be interesting to see if we see more pop up in that location. And we talked about data centers and electricity generation as a big source of demand, and LNG as another huge source of demand. But then another potential use of natural gas is to use it as a replacement for oil in making all sorts of chemicals and materials and things like gasoline. In fact, we covered this in episode 252, which was titled Turning Natural Gas to Gasoline. And that's through a process called Fischer-Tropsch synthesis. And this is not sci-fi. This is something that's been around for almost 100 years. It helped Germany, in fact, make fuel during World War II. And South Africa used it during apartheid when there was all kinds of embargoes against them to create synthetic oil and synthetic gasoline from coal. And so it's something where we could see natural gas used as a fuel source, run it through this Fischer-Tropsch process to create synthesis gas. You create long chain hydrocarbons, which then can be refined into fuels like gasoline. They have special catalysts they use and all that. So it's like having a magic wand that you can turn natural gas into gasoline. And so, it is something where while it's been around for a while, it is kind of expensive. It is kind of energy intensive. And think up until recently when natural gas prices haven't been so cheap, it maybe was not economic to pursue. But with prices so low, you have companies like Verde Clean Fuels and Diamondback Energy, which we mentioned in that episode. They're creating a pilot facility in the Permian Basin that's using the excess natural gas, that associated gas that's produced in conjunction with crude oil, that is extremely depressed in price. In fact, the Waha hub there in the Permian Basin, prices have been negative for natural gas a few times over the past year. So, extremely low price. And so they can take that, convert it into gasoline. This pilot facility could produce about 3,000 barrels per day of gasoline from natural gas. And that isn't really a lot in the grand scheme of things. We use millions of gallons per day, but it's a step in the right direction. And it could signal, if it's successful, the companies may scale that up to larger and larger facilities that could make a meaningful amount of gasoline from natural gas. And if that is the case, and that could be another huge source of demand for natural gas, that will exist as long as natural gas is undervalued relative to crude oil in terms of its energy content. And all of these things, I think, are very positive for the United States. If you think about it from an energy security standpoint, Justin, if we can make gasoline from natural gas, we're one of the largest natural gas producers in the world, in addition to being the largest oil producer. So it means that we have a tremendous amount of these base materials that we can use to create refined products, generate electricity in a reliable and affordable way, and then be the leader in AI as well, and then these other emerging technologies. So I think it's a very positive story for the United States. And in fact, I think it's a positive environmental story as well when you think about how we've reduced emissions over the past 20 years or so. And it's largely because we've replaced a lot of the coal-fired power plants with natural gas, which is much cleaner burning. And so it's certainly a positive story, whether it is powering data centers, fueling cars from natural gas, whether it's natural gas directly or even again that synthetic gasoline that's created from natural gas. Natural gas is really, there's a big opportunity for demand to increase significantly. And if all this plays out and more companies catch on and start utilizing this cheap natural gas, these low prices are not going to last forever. And I would not be surprised to see $12.50 natural gas, so long as, again, oil is trading at $75, again, just based on that energy content alone. So, Justin, whether that actually comes to fruition or not, time will tell, but it'll be interesting to see how it plays out.
No, you said it, man. And, the industries or heavy industries are no stranger to switching what types of power that they're using. We often see large plants that have the ability to use multiple types of power. And that may be the future that we're looking at. We've been talking about for a long time how natural gas is going to be so important in the transition. And I think this just really speaks to that. And we're starting to see that take fruition.
Yeah, exactly. So, positive story. So, if you're patient, hopefully you have natural gas royalties, and we'll see what this means is more demand for natural gas will mean more production of natural gas, more drilling in the areas where we have mineral rights that are prospective for natural gas production. So areas like the Haynesville Shale or Appalachia, where maybe they've not been drilling as much now as they have in the past just because prices are so low. But if prices were to go to $12.50, then I could see, again, a large boom in drilling, a large boom in production to meet that demand. And so, positive story for the U.S., for where we sit globally and all these emerging technologies. And then also just as energy security standpoint, I think it's a great story, and it's a big opportunity. So you see a lot of folks that are bullish on natural gas, like we've been talking about, looking to invest in minerals and royalties and hold on to those for the long term, and they thinking that this scenario might actually come to fruition. And if that does, then a lot of people could make a great deal of money. So, time will tell, though.
Time will tell. You said it.
All right. Well, thanks again for listening. Thanks, Justin.
Thanks, Matt.
Thanks so much for listening to the Mineral Rights Podcast with your host, Matt Sands. Don't forget to subscribe and share at mineralrightspodcast.com. The Mineral Rights Podcast should not be construed as investment, legal, or tax advice. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy.